Well, good morning and welcome. You're watching Market Cafe on ET Now. It's that show where we bring you all that's happened. We update you on all that's happened with regard to global news as well as domestic news, and on the specific corporate front if there have been any announcements. And of course, we update you on global markets. In fact, that's where we're going to start. Ankita, good morning.
Good morning to you, Harsh.
Oh yes, that's my co-anchor Ankita Saxena. I'm Harsh Saita, missed introducing. But Ankita, talk to us about what global markets have been up to.
Harsh, global markets have been very buoyant. On the back of the fact that, some sort of a conclusion might come in on the debt ceiling debate that's been going on between Biden and the Congress. And they're pretty confident that the US is unlikely to default on the payments. And that really got on with the markets, and they were pretty up and running yesterday. And stocks were up, like I mentioned, on the hopes that a deal on the US debt ceiling might come through. The House Speaker Kevin McCarthy said that a better process is now in place, and it is possible to get a deal by the end of this week. So all the investors, the market is factoring that in, and that really helped the markets yesterday. The Dow Jones Industrial Average traded 108 points higher, was up 1.2% in trade. The S&P 500 gained 1%. The Nasdaq Composite advanced 1.2% in trade. So markets were up and running, Harsh, yesterday. The European markets, however, closed mixed. The Pan-European Stock 600 index closed 0.1% lower despite the morning gains. DAX rose in trade 0.3%. CSE was down 0.1%, and FTSE was very, very flat, but ended the day in the red, down just marginally down 0.09% in trade. So largely flat. Food and beverage stocks recorded the biggest losses. They were down 1.3%. So that's the handover that's coming in from the global markets. Largely, I would say, a positive handover.
Well, yes, and that spilled over onto oil as well. We continue to see oil gain, in fact, and no surprise there, right, Ankita? I mean, we are seeing markets gain as well on the back of the positivity on the US debt ceiling getting resolved, that particular crisis. And as that gets resolved, demand worries will go away for oil. Growth will come back. At least that's the expectation, that's the anticipation. Let's look at where WTI is at. It's just below the $73 a barrel mark. We're seeing Brent also at just below $77. So definitely a positive on both those fronts. Let's though take it to what events to watch out for today. What should we keep our eyes out on, Ankita?
Right, Harsh, we will quickly look at the events that we will be keeping a track of as of today. We have the Eurozone CPI number that will be coming out, and the US crude oil inventories data that is also likely to come out today. And in the earnings calendar, we have the SBI, ITC, JSW Steel, NTPC and Power Grid that will be reporting their Q4 numbers. And in corporate action, we have Jindal Stainless Steel and Sterile Tech that will be considering a fundraise, and GIC Housing Finance that will be considering a revalidation on the issue of NCD up to 2,500 crores. And we also have the hearing by NCLT today on the SpiceJet insolvency case. So these are the events that we will be tracking very closely.
Right, interesting set of events, especially in the thick of earnings. You always have a ton of things to look out for. But let's quickly move on. Let's begin with what's on everyone's radar this morning. The US President Joe Biden and the Republican House Speaker Kevin McCarthy said they thought a deal to avoid a US debt default was in reach. Speaking at the White House, Biden had said, and I quote, "I'm confident that we'll get the agreement on the budget that America will not default. We are going to come together because there's no alternative way to do the right thing for the country. We have to move on."
Right, and Senate Majority Leader Chuck Schumer urged JP Morgan Chase CEO Jamie Dimon and other leading bank executives in a meeting to push all members of Congress to take the threat of a default off the table. Schumer met Dimon and other bank CEOs at the Capitol to discuss the debt ceiling and other issues. The huddle comes ahead of a scheduled meeting on Thursday in Washington between Wall Street leaders and Treasury Secretary Janet Yellen, with debt ceiling likely to be on the agenda.
Now, there are interesting comments coming in from IMF's Geeta Gopinath. She says she sees sizable risks that inflation will remain high or accelerate in many emerging markets and urged central banks to keep monetary policies tight. She added that markets were probably too optimistic about what it would take to bring down inflation in emerging markets. Meanwhile, she did sound optimistic over EMs, which is emerging markets, saying she expects growth in the region to hold up reasonably well this year.
And in the latest on the banking crisis front, UBS estimates a financial hit of around $17 billion from its emergency takeover of Credit Suisse. And the Swiss banking giant flagged a total negative impact of around $13 billion in fair value adjustments of the new combined entities' assets and liabilities, with a potential $4 billion hit from legislation, litigation, and regulatory costs.
And moving on to gaming giant Tencent. Tencent reported an 11% jump in quarterly revenue, marking its fastest growth in more than a year, as the company saw a big rebound in payment volumes, ad sales, as well as gaming. The results mark a strong bounce back to growth for Tencent after a succession of negative and flat quarters.
And cryptocurrency giant Tether has said it is going to purchase hundreds of millions of dollars worth of Bitcoin to back the world's largest stablecoin. The company said it would invest as much as 15% of its net profit into Bitcoin to diversify the reserves that back its USDD token.
Right, we'll slip into a short break, but before that, let me flag off where the SGX Nifty is at. 0.25% higher is the indication, Ankita, on the SGX Nifty. It's been a while since we saw something like that on our screens, especially in this show. So, looking forward to how the market's going to open, but before that, we'll just take a very short break. On the other side, we'll go domestic. Welcome back. You're watching Market Cafe on ET Now. Straight to it. Let's have a look at what Asian markets are up to. Well, largely in the green, as expected. We did see a 1% plus bounce across US markets, and that's pouring into Asia as well. That positivity, we're seeing the Nikkei, which is up 1+% in early trade. We're seeing Kospi up around 1/3% or thereabouts, largely flattish but slightly higher. We're seeing the Hang Seng up 2/3%. We're seeing the Shanghai also in the green. The ASX 200 on your screens 2/3% higher, and the Shanghai as well 1/3% higher. So across the board, we're looking at a positive start. Of course, debt ceiling again in focus for those of you who've just joined us. And we saw US markets in the positive as well, and that's pouring into Asia as well as our very own SGX Nifty, which is up around 1/5%. At least that's the indication it's giving us before the start of trade. Ankita.
Welcome back. You're watching Market Cafe with me, Ankita Saxena, and with me is my co-anchor Harsh Saita. It's time to move domestic now. Luxury electric car maker Tesla is gearing up for India drive once again. Officials of the company, owned by the billionaire Elon Musk, have met the senior Indian government officials today, apprising them of the plans to build its high-end electric cars in the country for domestic sales and exports, and sourcing more components. Remember, Tesla had put on hold its India drive last year as it asked the government to lower the import duties. My colleague Sumit Chaturvedi reported this earlier. Let's take a look.
Premium electric car maker Tesla is readying for another India drive. It seems the top officials of Tesla met top Indian government officials today, though officials of Tesla also included those from supply chain side. What Tesla has proposed is setting up another EV plant here, but how far they're willing to go this time, it is not clear. Remember, last year, Tesla had shelved its plans because Indian government did not want it to bring cars from China, though Tesla wanted Indian government to lower the import duties. Billionaire Elon Musk had jumped in the controversy, and he said that India should lower taxes. That time, Tesla had put on hold its India plans, but what we gather now is Tesla is once again looking at India plans with the plans to start manufacturing car here in CKD form and assembling cars mainly for exports to other markets and domestically selling. But how far they are willing to go, it is not clear. Tesla, clearly, we know that they make premium cars, the most valuable car maker in the whole world they are. But this time also, once again, they have come, and it comes at a time PM Modi is going to go to US on official state visit, and more developments can take place then.
Right, thanks for that, Sumit. All of those updates on Tesla. But let's switch focus. Future retail, once extremely sought after by both Reliance as well as Adani, have opted out from the race. ET now has learned from sources that 6 lesser-known companies have submitted the final resolution plan. Ankur Mishra has more details on this particular piece. Ankur.
Yes, big players who had given expression of interest for acquiring Future Retail has not submitted the final bids. So what we have gathered through sources is that the 6 bidders who has submitted the bid include Space Mantra, Pinnacle Air, Palgun Tech, Leher Solutions, Goodwill Furniture, and an e-waste management company. But this name does not include the big players like Reliance Retail, Adani Group JV company, April Moon. Remember, all these companies had submitted expression of interest for acquiring Future Retail. In all, there were 49 EOIs which was received for acquiring Future Retail, but the
moving right on then, India's electronic manufacturing segment has seen a huge boost in the last few years. PLI 2.0 will now cover hardware in mobiles, tablets, etc. Listen in to Ashwini Vaishnav, the Union Telecom and IT Minister, talk about the PLI 2.0 scheme.
Last 9 years, electronics manufacturing has grown from a very small, minuscule number to a landmark number of $105 billion last year. Large employment, 25 lakh employment has been created in this sector. This is a sector which is today recognized all over the world. Last year, our mobile phone exports crossed $10 billion. We ended the year at $11 billion. Building on the success of mobile phone industry, building on the success of telecom manufacturing, where people have already started exporting to US, Germany and France, building on those successes, the IT hardware PLI, which is laptops, servers, tablets and and the edge computing devices, very small form factor, high compute devices. All those devices will be covered under this PLI. Like the telecom and mobile phone PLI, the incentive will be at 5% as the base level, and then there will be additional incentives for using Indian components. Honorable Prime Minister sent me to US to meet in a very focused way, meet the semiconductor companies, met with about 45 companies and 2 universities, and each one of them appreciated Prime Minister's very practical approach towards developing the semiconductor ecosystem and creating a new industry in the country.
Right. We'll move on. We learned from reliable sources that Warburg Pincus has picked up a majority stake in Vistar Finance. My colleague Anurag Joshi joins in with more information on this one. Anurag.
Private equity firm Warburg Pincus has picked up a majority equity stake in non-banking financial company Vistar Finance. Sources told ET Now, Warburg Pincus bought a 70% equity stake last week from other institutional shareholders in Vistar Finance. These shareholders include Westbridge Capital and Sama Capital. Last October, Warburg Pincus had announced a definitive agreement to buy a majority equity holding in Vistar Finance, which specializes in lending to small and medium sized enterprises and microfinancing. Sources also tell ET Now that Warburg plan is to buy the remaining 30% equity in Vistar over the next 3 months. Kotak Investment Banking was the financial advisor on this transaction.
All right, then RBI has allowed SBI Funds Management to purchase up to 9.99% in HDFC Bank. The regulator has directed the to complete the transaction within 6 months. And we have my colleague Anurag Joshi is joining in with more details on this. Over to you, Anurag.
The Reserve Bank of India has allowed SBI Fund Management to purchase up to 9.99% in HDFC Bank. Currently, SBI Nifty ETF fund holds a 5.07% equity stake in HDFC Bank. The regulators asked SBI Fund to complete the transaction in the next 6 months, and the total stake of SBI Fund Management in the lender cannot exceed 10%. This is according to the RBI. This permission has been given by RBI at a time when the HDFC Limited and HDFC Bank are in the process of merging, and the merger has already got approvals from NCLT, from the Securities Exchange Board of India, and the shareholders. The Reserve Bank of India had separately allowed the merged HDFC Bank entity to increase its shareholding in HDFC Life Insurance and HDFC Ergo to over 50%.
Right, thanks for both of those stories, Anurag. Let's quickly move on. The government may soon issue a notification for an Indian size for the footwear industry. Remember, India currently uses either UK or US sizes in footwear. Let's go across to Sameer Dikshit, who's filed this report earlier.
The important and big news coming in for the footwear sector. Soon you will be seeing Indian size footwear in the market, and this is because sources have informed that DPIIT has done the consultation with all the stakeholders, and a final report has been submitted to BIS, Bureau of Indian Standard. Sources have also informed that it is very likely that BIS will issue a notification regarding the Indian size footwear within a month. The consultation was done with the stakeholders like the industry partners, the footwear industry, with other concerned departments like the Consumer Affairs Ministry, and now a detailed report has been submitted. Government initially wants to roll out this Indian size footwear as a voluntary sort of a step, in the sense that the domestic industry will be asked to roll it out on their self as a voluntary measure, and then government will see the response and then it will decide whether it's going to be mandatory or not. Now, why Indian size? Basically, if you see in the market currently, more than 90% of shoes, sandal, etc., they are having US or UK size being mentioned, but government wants that there should be a specific Indian size that should being mentioned, and this Indian size will be as per the need of Indian people, as per their comfort. Moreover, this Indian size will also help to make Made in India brand more stronger globally and help the domestic industry as well. And in the same direction, the government is now all set to come up with an Indian size footwear very soon. The consultation part is done, as we mentioned, and now BIS, they are likely to come up with the notification. Though there was some of the reservation from the industry side, like few of the global players, they mentioned that largely they make shoes for export purpose, whereas few industry players mentioned that recently a QCO was there for footwear industry, and another QCO might hit the sentiment. But government has said that they will be there hand-holding with the industry at all the time, and will look all the issues and will address accordingly.
Right, moving on then, solar panel maker Vari Energies is in talks with HNIs and family offices to raise 1,000 crore rupees at a valuation of 13,000 crores. Now, this is being done to part finance its capital expenditure plans. Now, the fundraising is aimed at trying up the financial requirements for its 8,000 crores capex plan, which will see Vari set up 6 gigawatts of manufacturing capacity, each for solar module, cells and ingots and wafers under the PLI scheme. Now, the Economic Times reported the company has already received commitments worth around 600 crores. The promoter group will invest around 200 crore rupees in this round.
Well, yes, let's quickly move on. Infosys has rolled out an average of 60% variable pay for the fourth quarter of FY23, which was impacted by a volatile market as well as uncertainties. Documents accessed by the Economic Times said, and I quote, "As we remain vigilant to the changes in the market, we must also see this as an opportunity to rally as a group and remain committed to navigating the changing business landscape. Employees will receive their performance pay in the month of May or as part of their May payroll. The company said that in an internal communication.
Welcome back. Here watching Market Cafe, and it is that time of the show where we get you all the stock specific action. And for that, we have my colleague Ansh joining us, who will be taking you through all the stocks that you need to keep on your radar for today's trading session. Over to you, Ansh. Tell us what are the stocks that we should be keeping on our radars for today's trading session.
Hi Ankita. So JSW Steel will be the first stock in focus for today's trading session, as the company has been declared as the preferred bidder for a composite license of an unexplored iron ore mine in Maharashtra. Apart from this, NTPC will also be in focus, as company has received a letter of intent by Gujarat Urja for 200 megawatt solar project. The project cost for which is 1010 crores. Moving on to Godrej Agroware, company is making significant efforts to help farmers. They are launching finance offering for oil palm farmers in partnership with SBI. In terms of earnings, REC has reported revenue at 10,243 crores, which is up by 6.3% on a year-on-year basis, whereas net profit saw a substantial growth of 33%. Jindal Stainless shows slight improvement in revenue growth of 7.7% on quarter-on-quarter basis, whereas net profit saw substantial growth of 40% at 716 crores. So keep an eye on these stocks.
Thanks for that, Ansh. We will keep our eye out on some of those names, but let's quickly move on. One name which will be in focus today, a banking biggie, SBI, all set to declare its Q4 numbers. A strong set expected from SBI, a solid 28% growth in net interest income expected. Keep an eye out on the margin number, but around 40,000 crore is where we are penciling in the NII to come in at. Operating profit will also grow in line with NII, 27% growth in operating profit. It's expected to come in at around 25,000 crore odd. We're looking at provisioning, which was on a low base, will continue to improve, will get lower. In fact, we are expecting provisioning, which was at 5761 crore, 5761, to come in at 5,500 crore on a sequential basis. So you're seeing lower provisioning coming through, and that both of those, the NII growth as well as the lower provisioning, will aid PAT. PAT will go up a solid 65% on a year-on-year basis to 15,000 crore, a 1% plus ROA also expected from SBI this time around. We're looking at GNPAs and NNPAs improving and will continue to show improving trends, below 3% GNPA and almost 0.7% or below in terms of that NNPA number. We're looking at a good growth on both sides of the balance sheet, around a 17% growth in terms of advances, and we're looking at deposit growth also expected around 6% on a year-on-year basis. But keep an eye out on that deposit growth number, because we'll have to wait and watch as to how the street looks at it, as well as how the management is looking to garner more deposits.
All right then, Harsh. Besides SBI, we also have an FMCG major that will be reporting its Q4 numbers, and that's ITC. My colleague Vinny, who tracks the sector very closely, is here with what the street is really penciling in. Over to you, Vinny.
In terms of numbers for ITC, we're expecting a revenue growth of around 7% coming in from the company. Profits expected to see a 15% growth, while in the operating performance also we are expecting an improvement there as well. EBITDA margins expected to see an improvement and expansion of around 340 basis points. EBITDA margins expected at around 37% versus 33.6% last year. What is supporting this, EBITDA margin, gross margin expansion is that, mainly a softening in terms of the raw material prices that has happened, which is aiding the margins of the company. And other than that, obviously there's a better operating efficiency as well, which is supporting the margins of the company. Cigarette volume, an important number we keep an eye out on, that's expected at 13 to 14% this time around. Non-cigarette business also is expected to do well, so that's the hotels, papers, FMCG business, that's also expected to see a good growth coming in there. Hotel business specifically, we're expecting a robust growth, mainly because bookings have witnessed a strong traction coming in there as well. So keep an eye out on the hotels business. Agri business, on the other hand, that's one thing that we could be seeing a decline in terms of the revenue coming in for the company. So keep an eye out on that one. Factors to watch out for in terms of commentary coming in on the price hikes. Are they taking any further price hikes in the cigarette business? FMCG, overall the growth as well as the EBIT margins, that's an important number you keep an eye out on as well. Corporate actions, anything that will turn out, any commentary on the demerger of the businesses is something that you should keep an eye out on.
Right, thanks for a roundup on that one, Vinny. ITC, another key player going to declare numbers. Let's quickly move on though. Vamakshi has been going through all the brokerages as she always does. Vamakshi, talk to us about the key ones you're looking at.
Well, yes, let's first start off with Amber Enterprises. We have a note that came in from Jefferies, and they believe that it is a very strong exit to FY23. The management is expecting the AC industry to post a growth of almost 15% in FY24 as compared to a 30% growth that we saw last year. Now, unseasonal rains in the month of May have actually impacted the offtake in the first quarter. Post-correction, the stock trades at a steep discount to most of its other peers, and that is the reason why Jefferies has actually maintained a buy rating on the stock. And not just that, they've also hiked their target price from 2870 to 3120 per share. Apart from that, watch out for Max Healthcare as well. Jefferies has maintained a buy but also hiked its target price on this counter as well to 600 per share. They believe that the numbers that the company reported were a marginal beat to their numbers. The EBITDA growth momentum is expected to sustain in FY24 given new bed additions as well as higher ARPOB. They've also hiked their FY24 as well as 25 EBITDA estimates by around 4 to 8%. The next stock on our radar is KFintech. Kotak has actually initiated coverage on this counter. They believe that this is a diversified financial infrastructure play. The MFRTA business is facing headwinds, but the revenue client diversification is critical. They see multiple growth levers in place beyond the duopolistic MF registry market. The company's strategy is to actually accelerate growth and that in turn will augur well in building its scale. They have healthy free cash flow conversion as well, and that they also expect 15% EPS CAGR over FY24 to 26. So a lot of positive factors coming there, and that is the reason why Kotak has actually initiated coverage with a buy rating and a target price of 400 per share.
All right, then, thank you so much for that. We will keep an eye out on all those stocks that were mentioned by the brokerages. Now, let's shift gears and look at the key takeaways from HAL Concall. The company has guided for a double-digit revenue growth by FY24-25 and the margin of 26 to 27%. My colleague Vamakshi is joining us again with all those highlights. Take it away, Vamakshi.
Well, yes, in the conference call yesterday, they did come out with a very good guidance for FY24. They believe that they will reach double-digit revenue growth in FY24 and 25. In fact, they're expecting to manufacture and commission LCA Mark 1, HDT 40, 25 additional ALH and SU 30 during FY24. They've also guided for the EBITDA margin between 26 to 27%. Their order book currently stands at 82,000 crores, a formidable order book. I must say, significant efforts to promote export are also being undertaken by the company. They're seeing leads from Algeria, Indonesia, Middle East, Thailand as well as Malaysia. Now, there are some supply chain concerns due to geopolitical conflict, but it is slowly now getting normalized. So that is a positive coming for this company. Now, Dhruv, on the other hand, had 3 incidents in the last 2 to 3 odd months. All these accidents aren't due to similar issue, and the Air Force is still flying through, but the Army has grounded through. So largely, those were all the important takeaways that came in from HAL.
Right, thanks a lot for that, Vamakshi. We'll move on. Coal India met up with Nuvama, or rather Nuvama met up with Coal India, and they met up with Pramod Agarwal, who is the chairman of Coal India. And let's try and break down as to what they are seeing in terms of commentary. One is that they believe costs have peaked out for Coal India with full provisioning of wage hikes which have happened in FY23. So that's a positive going into FY24. The other piece is that the absence of arrears will lead to a reduction in employee costs in FY24 as well. So that's a positive. Moving quickly on, beside the lower employee costs, you have prices of explosives and diesel, which has also declined, which is also a key positive for Coal India. They are expecting an 8 to 9% growth in terms of volume in FY24, and they are optimistic with regard to price hikes as well in FY24. Further, what Nuvama says is that the high dividend yield is ensuring a cushion on the stock. So that's what Nuvama's take on Coal India is after that management meet.
All right, then we had Jubilant Foods that reported its quarter numbers, and the numbers came in line with the street estimates. Vinny is joining us with all the Concall takeaways. Over to you, Vinny.
Absolutely. So in terms of numbers, yes, they were largely in line set of numbers, a slight bit of a miss that came in on the profit terms. But let's look at what the main highlights are coming in from the con call. The management has highlighted that, yes, inflation has continued in certain commodities like cheese, which remains even elevated as of now and could remain elevated in the coming 2 quarters as well. So maybe that pressure is one should watch out for. The company said that they will be furthermore focusing on value offerings and which will help acquire new customers. The highest priority is going to be given to improving their orders, improving the like-for-like growth, which saw a decline of around 0.6% this time around, and the inferred SSSG was a decline of around 3% as well. Now, this is what the analysts have highlighted. Now, other than that, the management is highlighting that they will continue to invest in new stores. New stores continue to perform much better for them and is able to meet the demand as well. So yes, new stores have been performing well. They'll be continuing to focus on opening more new stores as well. They will continue to focus on the LFL growth and identifying the white spaces there. They're targeting to open 200 to 225 new Domino's stores in India, 30 to 35 a new Popeye store in India as well in FY24. On terms of price hike, they said that currently they don't seem like they need to take a price hike. Their gross margins are quite protected, so no price hike seems like at least it's going to be coming in Q1 FY24 for the company. Consumer sentiment perspective, they believe it's not going to immediately start improving. Will take a couple of quarters to improve as well, at least. So that is something that you should watch out for. And the company will be focusing in terms of the 49 rupees pizza, which their value pizzas are there. That is not diluting the gross margins in any way. So yes, keep an eye out on that. Capex plan is of around 700 to 800 crores for FY24.
Right, thanks a lot for that, Vinny. Let's quickly also look at what brokerages are saying with regard to the result itself. We have Macquarie, which continues to maintain and underperform on the stock. They've cut their target price from 300 to 340 from 350, so that's definitely a negative coming in. They believe that the capex hike is despite a muted near-term outlook. That's a negative. They are expecting milk inflation to continue into H1 of FY24, and they're also suggesting that there's going to be a sequential margin decline going into it. Cost controls were unable to offset input inflation pressure is their assessment of the result. Let's quickly look at JP Morgan. They have a neutral on the stock with a target of 485. They believe that near-term demand uncertainty and margin recovery is going to be in focus. It's going to be there are a lack of meaningful triggers, especially in the short term, according to JP Morgan. Jefferies also holds maintains a hold on the stock. They've cut their target price to 450 rupees a share, and they believe that the tough macro and threat to near-term outlook is what they are building into their numbers. They've cut EPS estimates by 12 to 16% on lower SSSG margins. So clearly, not all looking good and bright for Jubilant, at least post the results and post looking at some of the commentary coming in from brokerages.
All right, Harsh, we'll move on then. Prateek Agarwal, who's the ED Business and Investment Strategy, Motilal Oswal Asset Management Company, believes that the India story remains consistent and valuations look fair and pretty sustainable. Let's look at what he thinks of the new age technology space as well. Listen in to what he had to say.
So the India story continues to be very consistent. There has been a slowdown in some small pockets like QSR, but by and large, it continues to be consistent. Now, in that makeup, when of the two large blocks of investors, FPI sell, domestic secular buy, we get a flat to a negative market. When the selling pressure reduces, you get a +1, +2% a month kind of market. And when both starts to buy, you get a 7% a month kind of a market. So it is basically that, we are at fair valuations. What you are looking at is earnings kind of compounding going forward, which if you split on a monthly basis is a percent kind of compounding a month. And hence you will see, or you should hope to see, long periods of sideways to down moves, and then a spurt when both the big blocks of buyers or market participants act in the same direction.
Where does the valuation picture come in now? Because nobody said that India was a poor story in 2022 also. Everyone said that India is a great market, but if you're buying silver at the price of gold, you ain't going to make money. So where is that logic now? I mean, the story, the appeal, the earnings is still there, but after the run-up, valuations are again rich.
So since you use the silver and gold analogy, well, there is gold and there is fool's gold. As of now, we do look like gold, on the lighter side. My construct of valuations in the marketplace is 18 to 18 and a half times 1 year forward earnings, something that I have been saying for a long time now. And if next year earnings are going to be between 950 and 1000, mood swings keep changing that number. The present construct is good. We have moved 1.5 months into the new year. You take 3 to 4% kind of compounding a quarter. So, half of that is over 1.5% into the new year. So very much sustainable levels to my mind. If you look at last 12, 13 years of the market, we are at average levels. Now, if you compare the two large asset classes, debt and equity, earlier, we were saying debt is relatively more attractive. Yields themselves were higher than equity yields. However, now debt yields have fallen, and now even on pre-tax, equity is very competitive. Post-tax, after April, for Indian investors, equity is super competitive versus debt. So that is the thought on valuations. If you are a domestic investor, I think, and long-term, then equities is the place to be in, to my mind.
Why do you like new tech? I mean, nobody likes new tech. They are not making money. There is an anchor selling which is there. There are Chinese investors which keep on selling. Why do you like new tech? You're smiling a lot today. You're smiling a lot. Am I asking you the rash questions? Am I asking easy questions?
You like new tech.
No. You're smiling a lot today. In over the years I've seen you, I've never seen you smile that much. So I'm not complaining. But I'm asking easy questions.
I was more because you were tingling me on that side. So I said, let's have some fun.
Okay, new tech now.
So we have been saying, while market participants may not like new tech, the kids like. Okay, and kids are the future. Look at it this way, on the lighter side. Second, we have been saying these are great businesses, good valuations, but ownership changes will cause volatility. We have been saying this for past few months. Today, if you see across our house, we have a sprinkling of one of the two or maybe three new tech names across our funds. We do believe we are quality and growth investors. Today, on valuations, frankly, 100% of the street has put significant upside to all of these names. Liquidity is good. Growth will continue to be there for a very long time. So for a quality and growth investor like ourselves, these are spaces to be focused on. After the fall, valuations became good, and that is the reason we have got a sprinkling of them across our funds. Not very high number, but a sprinkling everywhere.
Right, those are the views of Pratik Agarwal. But with that, we're completely out of time on this edition of the show. From Ankita, myself, and everyone who puts the show together, thanks so much for watching. The market will take the action forward. We have a positive on the SGX network.